With us, I just pointed out how we'd seen some selling to begin the week, the year. It's kind of eased, it's slowed some of that momentum to the downside, but not the start the bulls were looking for, to say the least.
No, and I saw the report that came out that said Brent crude starting off the worst start of a year since 1991, so down about 9.1%. I do believe, though, that energy prices are in a sideways pattern between 70 and 80 for WTI. We are starting to cycle back up. Markets tend to fall twice as fast as they rise. That's why you got a two-day sell-off like that. Looks pretty dramatic on the charts, but I think we're going to build some support here. I don't think OPEC's going to let the floor fall out on it. We did have that cyclone that came through, that winter storm last week. That's probably going to take and create a build here on the inventories. But like you just said, 60 degrees in Chicago. I think everyone's out zipping around on their cars. So we'll see a drawdown. No
one's complaining, that's for sure. And that near double-digit loss that we've seen percentage-wise to begin the year that you pointed to, it comes after a couple double-digit percentage-wise losses on a weekly basis we had seen in crude after it came off that high up around 93. So the move I was just looking at from 85, just part of that bigger picture move. We saw a double top, I think it was September, October around 93, and we've come off. But again, in a bit more of a sideways pattern here, as you mentioned. And I guess I'm wondering, would that kind of shift that sideways pattern sort of a mindset here if we were to take out that $70 low that we saw last month?
Yeah, I don't think we're going to do that. I think we'll hold a $70 low. So I think it's a buy the dip, sell the rip type of trade here. So we get anywhere close to 80, take those profits. We get down in these, we retest the lows here today. I think you start building a position.
Phil, as you say that, I'm thinking here this morning's my walk with my dog was not as pleasurable. It was Monday, Tuesday, and Wednesday. I mean, things have cooled off here. How long can this warmer weather last as we're into the middle of January, February, very cold oftentimes here in Chicago, across the Midwest. So weather a factor here. And ultimately, I pointed to that with my chart of the day and how we've seen natural gas prices come off as well.
Natural gas been a complete disaster. And you remember that traders tend to build positions coming into, November, December for those January, February, March. So they're not seeing any kind of indication that we're going to have this cold front come through. They got to liquidate that January. They roll over to February, and it becomes this snowball effect of liquidation. So you got natural gas down another 6% today. Looks pretty ugly on the charts. How low is too low? I'm not sure. I think that Europe really dodged a bullet with an unseasonably warmer winter this year. So, it really helped out. Otherwise, we could be double-digit nat gas if it would have been, a repeat of last year.
And a worst-case scenario, Putin scenario not developing, as I've been pointing to as well. It seemed that situation fairly tame compared to what it could be. Let's talk a little bit about how this is not just what we're seeing in terms of weather. I mean, a big part of this also, there's some concerns about recession. We heard from the IMF to begin the week, and they kind of pared back some of our expectations as well. There's some demand concerns out there, Phil.
Yeah. It's the global growth outlook. It's really come down, the recession outlook. You're going to see people do less driving, especially if you get any kind of spike up in gasoline prices. But I just think that everybody, you look at like food, energy, shelter, and you go to the bottom income earners, that takes up about 62% of their expendable income. So, people are really strapped right now. And this inflation is going to remain sticky. As you guys were talking about the FOMC minutes and everything. The Fed's just really quite hawkish going into this year, and I think that it's going to kind of tighten the belt on a lot of these commodities.
Phil, is inflation remaining sticky? What we're seeing in terms of gold, it seemed to be a dollar story headed into the end of last year, but this year, just to begin the week, we've seen a couple days where gold's been up, the dollar's been up simultaneously. Not what you'd expect to see. I guess I'm wondering, is that more tied to some of those expectations?
Gold's doing a great job here, and it's got a little bit of a lost momentum here today since the start of the year. It's still fighting the uptrend, and that uptrend still remains in place all the way down to about 1805, 1800. I think it's doing its job. You have a lot of these different other really speculative asset classes, a lot of tech bubble, Bitcoin, things like that. The FTX, they've really expose some of these weaknesses, in the entire market here. And I think a lot of people are coming back, and gold is going back into that traditional safe haven asset, spot to park your money. The Fed eventually will be done raising rates. At that point, I think gold gets its next leg up. I think we could easily go through 2000 this year without even any difficulty.
You know, I got to take a heartbeat here and just kind of point to something. This chart that we just had up, if we could pull this gold chart, this was the daily time frame we just looked at a second ago from 2078. Now, that's not the all-time high we saw in reaction to the pandemic. I'll get there in a second. But from 2078 down to 1618, look where we are for the most part in the middle of that range. So just kind of feeding into that theme that I was talking about at the top of the show, how price activity is relatively contained. And then look at this. To your point, Phil, I mean, gold has performed well for the bulls. You can see, again, the strong run-up that we saw into that pandemic high up around 2100, and look how we're holding that upper level. And we were just looking at this move from 2080 down to the 1620 area. We found recent support, but look at this bigger picture range that we've been in since those all-time highs. I mean, for the most part, holding in the middle of that range as well. So just wanted to point to that. What are you seeing in terms of copper? It's coming off a little bit here. As it seems like that China reopening trade was a bit of a disappointment. It ran copper up into the $4 level, but couldn't take out key resistance, Phil.
It flipped a neutral trend on my chart, my system. We got to break out back above 388 to trigger a new buy, or a breakdown through 370 in order to trigger a low. I think it's trapped right now. If you throw up like the 50 and the 200-day moving average, I think it's like trapped right between the two. So we'll see a breakout to the upside or downside in order to establish new trend. You know, I mean, we're big momentum traders over here. We use a lot of technical analysis. I think the information you're receiving from China is a little bit dicey. 1 minute it's, you know, 20 of the 25 million people in one city, 75% of them have COVID. You know, that's not bullish at all. Yeah. And then the next thing you know, it's like, oh, we're going to put stimulus in the market and we're relaxing those COVID restrictions. I don't know if that's doing any good either. So that's why you're getting this sideways choppy market. We'll see which way we break out, and we're just going to go with the flow.
30 seconds, Phil. Silver, a similar situation. I saw it coming off significantly, and kind of just speaking to that industrial metal concern.
100% tracking copper right now. Done a great job against gold. It was 75 to 1 on the ratio, which has come down significantly from 95 to 1 just a couple months back.
Silver's done a great job against gold, to say the least. And Phil, you've done a great job for us here, breaking it down to start the year. A happy New Year to you and everyone at Blue Line. From us here at the TD Ameritrade Network, Phil Streible, the Chief Market Strategist.